Boom. We are alive, ladies and gentlemen. Another interesting conversation. That's what we're going to do this evening, this time with Perp.Fi, decentralized index that's offering derivatives or leverage, perpetual swaps. So we're going to figure some of that out because I'm sure I've got one of those wrong. So we have Yenwen Feng and Nick Tong of Perpetual.Fi or Perp.Fi. I think pretty sure Perp.Fi, that's how you'd find it. So just make sure we get that part correct.
Yep.
So when everyone's looking, it's easy to go. How are you gentlemen doing this evening?
Good. Thanks for having us.
Yeah, my
Yeah, thanks
pleasure.
for having us.
It's it's always fun to learn. I'm not as we're going over kind of the early part of this call, I'm not much of a tech guy, so I like to find aspects that I believe to be conceptually valuable over the long term and see where those conversations take us. So Yenwen, you're one of the co-founders, right?
Yes. Yeah, I'm the co-founder.
Do you want to take us a little bit through the history of the company and to where we are today?
Sure, of course. So we start actually when we start it's not Perpetual protocol. So we fell down into the crypto rabbit hole in like 2018. So a long time ago. I mean, at the time there is no DeFi yet. So there are projects like Compound like popping up, but it's very exciting at that time. And we actually are more interested in gaming. So crypto kitty, I mean, at the time it's huge. I mean, people really feel that NFT games are the future, stuff like that. We actually want to build a game, so that's what drove us to crypto. But in the end, we don't really think the crypto gaming is not that kind of attractive. So we actually found that trying to build financial instrument on top of blockchain is very interesting.
Yes.
So yeah, so 2018, we actually are working on an option protocol at that time, which is kind of like actually before DeFi, people call it DeFi. And but it's not going well. I mean, like we have hard time like understand like what we are trying to build, and then also hard time to attract like funding. And the market crash actually in the end of 2018. So we actually end up joining Binance Lab. So they have this incubation. So we joined their program, and then we pivot to kind of working on a crypto accounting software at that time, which is totally different. I mean, we work on that for a year. It's a little bit boring, but still interesting because it keeps us like in the field. And in 2019, actually, I mean, things start getting interesting because Uniswap and Synthetics. So Uniswap actually got some traction. Just like within the, so for traders like who really want to be decentralized, they trade on Uniswap. Uniswap have this AMM. I mean, it's not the first one, but it really, kind of like proved the point that AMM actually is the key to a decentralized financial instrument. So we actually learned that during that time, and also Synthetics has a very unique design. So we end up dropping the crypto accounting software, and then we just pivot back to working on DeFi. So like the end of like 2019, early 2020, we just like go out and trying to so we still want to do derivative. So we just try to kind of like pick another instrument because option is actually really hard to us.
Yes, yeah. Options are a very interesting conversation just by itself. I mean, Nassim Taleb's books like Anti-Fragile or Fooled by Randomness, of just the idea of having an option, not even just in the financial sector, but when you break a concept apart. What I like, I'm always fascinated by the story of the entrepreneur too, because there's a lot of pivots along the way. People often will think that you end up where you're going because that's where you were aiming when you started, and that's so often not the case. You're often discovering where you're going and constantly finding like the next steps up the mountain to some degree or another. So I had when did you start building the Perp.Fi, and I guess from here, Nick, if you want, where are you guys? Hold on, let me try to phrase this question properly. So there's a lot of different automated market makers, right? I remember we went from Fork Delta, like Ether Delta, from the early days, like the first part, and it was amazing, right? The decentralized potential of financial instruments, and from you've got a bunch of indexes like Uniswap, and we've seen this open source kind of amalgamation where you had Uniswap, and then there's SushiSwap, and then everybody had an automated market maker effectively. How do you break out of the noise of the open source industry that's trying to eat each part of itself? Does that make sense? Yeah.
Yeah, it's if I were to try to rephrase, from my understanding, it's like how do we differentiate ourselves from kind of, there's loads of different AMM projects out there, and kind of how are we different? And I'd answer that in a couple different ways, but I guess first is you take a look at kind of the prevalent ones right now. You've got Uniswap is probably the biggest one. Well, it is the biggest one, and people love using it. It's a swap product, and what that means from a spot product perspective means that you just swap 1-to-1, right? So, but a lot of traders are really looking kind of for this kind of capital efficiency or leverage. So how do I kind of leverage up, and how do I get more exposure with kind of less assets, and obviously the risk increases, you can earn more, but you can kind of get wrecked harder. And this is kind of not quite possible in DeFi right now. It's possible in centralized exchanges through like margin trading, where you can kind of borrow assets and then kind of leverage up that way. But the problem with kind of margin trading is it's pretty expensive, right? Like, it's super expensive. And so perpetual swaps is a really interesting mechanism for us to kind of bridge that gap. So first off, you don't need to own the underlying asset. So if you can imagine, like, you just simply deposit USDC, you can trade DOT, you can trade Bitcoin, you can trade ETH, you can kind of trade any asset. It doesn't matter if it's ERC20 or some other kind of protocol. And then the beauty of that is you can leverage up, and then you don't need to pay the expensive rate the kind of margin trading has to have. So I say that's probably the first piece of how we kind of differentiate ourselves from a lot of the other AMMs. And then the second piece I'd say is, like, in the derivative space itself, we're a little bit different, I guess, to what you normally see on centralized exchanges, which is a limit book order model. So people kind of place orders on the limit, on the order book, and then it gets filled off that. But we've kind of replaced that with an AMN effectively. So, and this kind of gives us a lot of benefits. So the first one, and the biggest one probably, is like a lot of the centralized exchanges, for you to list, you kind of need a market maker. It's very permissioned, and so you can imagine it's quite an expensive process. Both from paying the market maker and kind of lending your tokens out so they can kind of market make, and then kind of paying for the fees to kind of list. But because we're an AMM, we need liquidity, but we don't need sophisticated liquidity, so to say. So it's a lot quicker for us to kind of launch a lot of markets. And similar to Uniswap, we can then do the long tail of the assets. So we can list anything and everything. And I guess this, I'm guessing we're going to talk about this later, but this is definitely the case with kind of Curie and V2 and how we kind of have private markets along the line. So I'd say those are probably the key differentiating factors, I guess, from both kind of an AMM perspective and from like the derivative space.
So, one of the things that's interesting for us is kind of always these abstract or the adaptations, the pivot of something. Like when we first came up with lasers, we didn't really expect we'd be editing people's eyeballs with them necessarily, but that's what we started to do, right? There's these big kind of gap changeovers where when we first discovered the technology, the potentials to us yet are not even fully fully aware. So one of the part where I want to lean into right now, and I'd like to go more macro on this idea in a second, is after this question. But so how are you achieving with the derivatives this perpetual swap? How is that built? That's what Curie is effectively, the Curie update that you created? Do you explain that?
The Curie update, or kind of Perp in general, I guess.
Well, so I think most people understand the perpetual swaps to some degree. How are you accomplishing it in the decentralized world through smart contracts? I guess is the question. Like, are you connecting to other liquidity pools? How do the derivatives break? Is there systemic risk in those derivatives? There's a whole avenue of conversations we could go down there, but maybe just a rough overview of how that's accomplished.
Cool. Maybe I'll go very quickly and kind of talk about V1, and then we can talk about V2 and the changes there, just to give some context. So with V1, we've implemented, I guess, what you call a virtual AMM. So instead of, so if you think about, you have a Uniswap pool, and let's say I have an ETH and a USDC pool. If I want to go long on ETH, I put in USDC and I receive ETH back. So we kind of built upon that idea, and we said, okay, how do we create leverage through that? And to do that, we basically something similar occurs. But so a user comes in, they put in USDC, let's say 100 USDC, and instead we will then mint virtual tokens, which is a representation of that asset. So in our case, we would mint, let's say, if ETH is, let's say we want to go 10x or whatever it is, we would mint 1,000 virtual USDC, and then we would just basically do another swap as though we're doing a Uniswap swap, and we'd receive virtual ETH on the other end. And so that's kind of the way we've kind of done. It's more like an accounting system than anything, but that's kind of a little bit more technical on how we've kind of done the implementation in V1. In V2, the upgrade that we're actually doing is there's kind of three pieces of upgrades. The first one is around public and private markets. So less relevant on explaining how it works, but in a nutshell, if you look a lot across the derivative space right now, a lot of the projects basically requires some form of permission in order to list a market, and that's usually through some form of governance first. And the reason for that really is that a lot of the time, the assets need to kind of be taken into account how risky they are, because if one asset kind of goes to zero or the market crashes, it kind of impacts all of the other markets, and so you kind of don't want a toxic market, like you don't want to launch a toxic market. The beauty of the private markets is you effectively isolate that market from the public markets in such a way that even if the private market goes to zero, only that private market is affected. So that's kind of the first upgrade. The second upgrade is actually around the way that we do the pricing engine. So in V1, we use Uniswap's kind of XYK as a pricing mechanism. And if you think of it in kind of order book terms, it's as though you're placing equal amounts of liquidity across the entire order book. So it's not terribly efficient, but effectively what we're doing is we're replacing that component with Uniswap V3. And Uniswap V3, that means we can then get concentrated liquidity, and it allows for a couple of other things. So the first thing is that with XYK, it's actually quite prescriptive. So traders can only trade in a particular manner, whereas in this kind of new one, basically traders now have the ability to kind of express themselves. Mm-hmm. And then finally, the third piece is really around how do we upgrade most of our other protocol, other kind of functionality to get to a similar experience to kind of centralized exchanges. And so there's a lot of kind of different feature updates there, but things kind of like cross margin, things like multi-collateral, and so forth. So I'd say those kind of are the high-level updates we're doing kind of with Curie v2, as well as kind of how v1 works in a nutshell.
Okay, great. You know, I think the financial tools are such a fascinating concept. Again, I try to break things and remove most of the pieces and just look at broader strokes of ideas. For instance, like just if it's a distributed system, I'm interested in the fact that it's distributed, not how many of those distributed systems there are. So that brings us to kind of an agnostic blockchain type question. Everything's written in Solidity that you're working on, correct?
Yes.
Well, how do you feel about the production of Ethereum, where it's going? Are you guys focusing on going into layer 2 optimism solutions, or are you aiming, what's your focus on scale in terms of fees or incentivizations, or even potentially other layer ones?
That's a good question. So the Perpetual Protocol V1, so we are currently on top of XSky. So we are actually on a layer 2 on sidechain right now. So scale, I mean, like people can start by transfer the token from mainnet to XSky, and then we offload all the operation on XSky. But for V2, we are actually looking for like other like layer 2 solutions as well, such as like Arbitrum or like Optimism, because in V2 we actually rely on Uniswap V3. So I think mostly we will be on Arbitrum or Optimism. Okay. And awesome. Yeah, but personally, I believe like 100% in the roll-up in the layer 2 solutions. I personally believe that the Ethereum scale will scale be the king of like all the programmable blockchain. Yeah.
Yeah, it's so, I mean, it's such an interesting question because technology moves so quickly, and it's one of the kind of the interesting part about especially open source technology too, because it does seem to consume itself and become more transposable, almost like how music moves through every instrument is different, but the fundamental piece is still the same, which is we're looking for decentralized, distributed systems where we can hold contracts between one another for collateral layers that have a very high value lock effectively. So however we accomplish that, a lot of the times is unimportant. People will actually choose different things depending on. So part of my question there was also then to land us in the second spot, which is, can you, again, as a kind of a layman technologist, how would you conceptually express the difference between optimism and Arbitrum? Because some of this stuff is new to me. I try to not focus again too much on the technology because I can't catch up. But if these are perfect conversations for me to try, like, how do you conceptually explain the differences of some of these things?
That's a good question. So I mean, of course, technology-wise, they are very different, but they both based on a mixed cake roll-up. So conceptually, they are alike. They're kind of like 90% alike. So they come out with a different way to approach it, but they are 90% alike. So actually, the problem of adoption, kind of shift to like when can they ship?
Right.
So like Optimism, they kind of they are ready to ship. So I think they have a little bit like head start. But technology-wise, I think they are very alike. So of course,
so it's like it's a fair amount of branding then per se. People are trying to close branding into their. Does that leave a domain dependence for the value as people get locked into certain areas? Like, do you suspect we'll see like groups that grow into Arbitrum, or will they all naturally ending up in the place that's the most productive for everyone, wherever that might be? How do you see how do you see the changes between, if they're so similar? It seems to be somewhat brand based. The first question is, can value get stuck in those areas and get like you have a small community of people that just are diehard Arbitrums? Now they're Arbitrum maximalists or whatever. Like, does that happen? Do you think as well? Do we have these like community locks to just go into different niche areas for this stuff?
I think they will definitely be like arbitron maximalists. I think that, I mean, there will be like a group of people like that. But I think so. Actually, I think this is an interesting question because, I mean, previously I see, you talk a lot on like Avalanche, which is a fantastic technology, which is a layer one chain. So, I mean, I know like people like a diehard like Avalanche fan. Actually, personally, I like Avalanche a lot. So I know that. But for rollup, I personally think this is a little bit different. Rollup, I mean, the interesting thing about Amazing rollup is that they still use the Ethereum as the security layer. So which kind of like you only offload the computation onto Arbitrum or Optimism. So which I think which make them more like, really a layer 2 to Ethereum. So people who believe in Ethereum actually accept Arbitrum. It's kind of like the same group of people. If you believe in ETH, if you are ETH maximalist, you actually have faith in Arbitrum or Optimism. So I think they are actually
like
kind of like the same family.
Yeah, like programmer soft forks. Where it's like we're all going to start working over here now instead.
Kind of. So that's actually, I think, the main difference between this new layer 2 or like sidechains like Sky. People support. There are a group of people who support Sky. There are a group of people who support like Polygon. But I think people who support Arbitrum are the same group.
How well can, say, Arbitrum and Polygon communicate? Like, can they communicate value between, or do they have to go back to the main chain and settle?
Mm-hmm. Yeah, but from a software point of view, they are actually alike. So like we are working, our software is working on Sky. But using a sidechain is not very different from using a layer 2. You still have to kind of switch to another network.
Right.
So Polygon, they have this like Solidity compatible network, so you can easily switch. The same as Avalanche, they also have this like compatible network that you can easily switch. The same as BSC. Yeah. So I from user point of view, I think they are the same.
Yeah. Okay. So, I mean, part of the reason why I'm wondering is, with all these different choices, do you find that same kind of niche community that just starts to build and use certain like they become, Arbitrum or Avalanche? Because I guess to some degree, the user interface is getting much more evolved, especially from where we were with EtherDelta or something too. Like, we've made leaps and bounds over the last 3 years. So I'm trying to also envision how we make some of the curves too, how we go from, I like your guys' application, and maybe what we'll go into next is you can kind of take us over what you've built and show us, because I think the user interface or the community interface, whatever you want to call it, is of such an invaluable part. Because when things become effective, it usually the normal person won't be able to tell that they're using such advanced products. And right now it's still extraordinarily advanced. Like, the average consumer is not able to easily identify. It takes a little bit of practice, whereas something like WhatsApp or Facebook doesn't really take practice. Like, it sucks you into all of a sudden being addicted to the damn thing. Like, no, it's not. I don't want to spend so much time looking at Twitter. This is ridiculous. So. That community interface is such a huge part, because it's where the relationship with the brand and some of the value transfers come through. Maybe, Nick, if you want, we can do the screen share portion now and run us over the application. I think that this is
sure.
One sec here, Makos. There you go. You should have the capability to do it now.
Oh, let me just share my screen.
Yeah, so these are all exercises in conversation. There we go.
There we go. Can you see my screen?
Perfect.
Cool. So this is just this is the kind of the main screen that you can see. It's pretty similar, I guess, to what you would normally see in, I guess, other centralized exchanges. So I can just go through very quickly all of the components, I guess. So this middle bit obviously is your regular kind of candlestick chart. It shows you the price. In our case, we've kind of got the curve product here. The left-hand side here, there's a toggle here for basically to figure out and change kind of any of the pairs that you're after. We do have a nice little bit here where users who kind of are after a different pair, they can kind of put it in here, and it kind of gives us a little bit of data around what our community wants next, and then we can kind of vote on it. On the top here, you've got kind of you can see there's two balances. So the main thing that I'll note right now is I'm actually on, even though the application is built on XDAI, I'm actually on Ethereum right now. I'm connected to Ethereum, so as a user, I don't really need to know the difference between kind of Ethereum and XDAI. So the two numbers here. So this number on the one I've got highlighted is basically I've got $670 odd in my Ethereum Layer 1 wallet. And the $10 here is actually my Ethereum, my XDAI wallet that I've got. So when I deposit, everything continues to be non-custodial. So all it's doing is it's transferring assets from my Ethereum wallet over to my XDAI wallet. And that's it. There's a zero gas deposit campaign that we're kind of running right now, which basically subsidizes any of the gas costs that it takes to kind of bridge the assets across. Right. But that's pretty much it. It's relatively simple. And then withdrawal obviously is the other way around. You go back from XDAI over to Ethereum.
Sorry, it was funny because I love the zero gas deposit explanation, and the withdrawal was just funny at that point. Sorry, I think that's a great idea. That incentive to get people to enter the ecosystem, brilliant play right there. Nicely done.
Thanks. And then basically on the left-hand side here, we have a couple of other things. So in this case, we're looking at the curve market. So I can put in the amount of curve that I wish to purchase, and I can kind of toggle the collateral that I want to use. Alternatively, I can actually fill straight from the collateral. So if I've got like 9 USD, I can kind of put it in here and place the order. There is some information down here then on the transaction summary. So like how much fees you'll pay, potentially how much price that you're impacting. And then the final piece really on this order side is this slippage tolerance. Most of the time, like I'd say like 90% of people really don't need to care about it, but it's more for people who kind of want to, like they really care about a price, like maybe they're putting in a large order and they want their slippage to only be like, I don't know, 0.2% for whatever reason, that they can then kind of come in and update that here. And obviously when they place their order and it kind of goes outside of that slippage tolerance, the order doesn't execute, which is great for them. The last thing really is I place a trade. I basically just sign a transaction, and then the order gets placed and it gets filled. On the right-hand side here, I've got a couple of other interesting points. So the mark price and the index price, estimated funding, and kind of the 24-hour volume. So just your regular kind of market information. The index price is actually the Chainlink Oracle price that we use, and then the mark price is the current price of the market itself. The funding payment then is the mechanism, I guess, in the perp swap, where depending on the mark price in relation to the index price, it goes positive or negative, and it kind of basically tries to keep things in balance, obviously. On the right-hand side here is basically all of the orders that have happened for this particular market, so for the curve market. And then if I go to the final piece at the bottom here, you can kind of see my position here. The asset, kind of the position size, the leverage, and everything else associated with it. There's two things I can really do here. I can basically close the entire position, or I can maintain my margin. And this basically allows me to have a more granular control of what I want to do. And the reason for this is all of the system right now is an isolated margin versus a cross margin. What that basically means is kind of we lock up collateral on a per position basis rather than having a single pool of collateral that kind of acts as the backstop for all of the positions. Cross collateral, the cross collateral is coming out in Curie in V2. But this maintenance margin basically allows you to kind of manage that margin. The only other things I would say, we've got two other tabs here around kind of trade history and funding payments, which is kind of more around your historical like information or funding payments you've received or paid, or like the actual trade history that you've done. But that's about it, I guess. In a nutshell, it's nice and simple. People are used to it, and it's relatively easy to trade on.
Yeah, it looks great. Very easy, intuitive interface for anyone who's ever played or used leverage. It's a very, very useful tool, especially at the right time. It can be very dangerous, though. I always remember people don't play with leverage if you're new. It's for advanced users only. But this is a great product place. Can you? So part of that was part of the technical question. I'm trying to figure out how does the derivatives work for, like how does that background process work for using the leverage within the pool? Does that make sense? Because when it's a centralized pool, it's easy to make sense of, like, okay, I'm trading against like a pool of collateral from FTX, so putting up both sides of the trade. So with Coinbase, I can see both sides of the trade. I still can't. I can't always see it in the decentralized world. Like part of me feels like, is there? Yeah, here's one way to phrase this question: is there risk within the system of a blowout in really chaotic, volatile moments?
Yes, that's a good question. So definitely there are risks. If you take a leverage, but the risk, I think that's so definitely. It's decentralized. Smart contracts. So it has smart contract risk. Of course, that's the first thing that I'm not going to hide. So they risk this kind of risk, but right. Besides this, compared to centralized exchange, for a decentralized project like us, you can see all the operation on chain, you can see all the trades on chain, and we kind of like we publish all the source code, so everything can be verified. So on that part, I think it's not like when the market goes down a lot, and then you found that you cannot access the exchange, the central exchange.
Right. So, part of my thought. I'm sorry to interrupt, Yen. When you, I guess what I'm curious about, and again, it's probably because I don't know the tech layer extraordinarily well. Again, conceptually, okay, I can make sense of a lot of this, and then trying to simplify things, anyways, because it's just easier that way for me to understand. But
sure.
Like a lot of hedge funds, for instance, will do really well until there's a barbell moment, or there's a highly volatile tailwind moment, and then all of a sudden, a bunch of hedge funds or insurance companies that had done well for sometimes decades just all of a sudden disappear because they weren't able to measure that systemic risk. I know it's a really hard question to ask, because I'm asking to try to predict the unknown to some degree. What are some of the unknowns in the risk tolerance for an extraordinarily extreme event where, say, someone was highly leveraged with a small position? Could they, like, how could that affect the other side of the pool negatively, in terms of, like, all of a sudden they just made an extraordinary amount from one side of the trade? Oh, I'm gonna have to switch a battery, but that's my thought.
Yeah.
I'm here still. Sorry.
Okay. Yeah.
So I'm still here.
Okay. So I think that's a really great question. So for our system, actually, that's where the whole that's why we spend so much time on designing this AMM. So like I said, you understand how the centralized exchange work. They are market makers. They provide liquidity to the system. They kind of have to. The platform has to make sure that the market maker, can still provide liquidity when the market is really volatile. So I think that's the case for centralized exchange. For decentralized exchange, for example, for our V2, we have a group of people who provide liquidity. So we just like liquidity provider on Uniswap. So they provide liquidity. Just like centralized exchange, but they do this in another way. They have this AMM. They have different kinds of control the liquidity they can provide. It's not so, active. You cannot provide liquidity as active as market maker because, on centralized exchange, market maker actually can place lots of orders, but they don't fill. But on an AMM world, you have, when you provide liquidity, kind of you have to expect that you will get filled. So it's a little bit different, but I think in some sense we have that. We have that. Those people providing liquidity, just like Uniswap. I think the most interesting thing in decentralized world is that there are lots of automation. So people building, like Uniswap V2, the AMM is one kind of automation. So it kind of if you want to provide liquidity, you can just put ETH and the USDC in the pool, and then you become a market maker. In traditional finance, it's so easy to do. And the most important thing is that for Uniswap or for us, we actually give the liquidity provider most of the transaction fees. On central exchange, the market maker, they got rebates, or sometimes they just they got their fee waived. But here, you actually got more fees, so which actually make it more, easy to provide liquidity because a lot of people know that there are implement laws on Uni V2, but they still provide liquidity because the fee. The fee is actually enough to cover that. So the same thing here. It just kind of switch the paradigm, and then everyone can provide liquidity, and then most of fees go to the liquidity provider, which make it really easy for people to earn money there. So I think that's still people provide liquidity, but the kind of structure change, which make everyone can provide liquidity. That's I think a difference.
I think another piece around that is kind of another risk is I think you're alluding to kind of like the liquidation risk, and so in that sense, I think we have a similar risk profile to, I guess, centralized exchanges, where your risk effectively is if you can't liquidate a highly leveraged position in time, then you may have kind of bad debt that's kind of created, right? To kind of solve this, we have kind of from a liquidation perspective, it's kind of open sourced in such a way that anyone can basically call this function and kind of run their own kind of bots to make sure that everyone who should be liquidated does get liquidated, and they receive kind of a small reward as part of it. So we haven't really had any problems in that regard. And then the second case really is we have an insurance fund, similar to, I guess, your centralized exchanges, where in the case where a black swan event does occur and we can't liquidate people fast enough, there's an insurance fund that can basically take the other side and make sure traders are still whole. Oh, I think you're muted.
Thank you. There's always one of those tailwind moments where you just have an extraordinary amount of volatility. So I'm always interested in how we account for that, because it's one of the internal problems with the centralized anything that we've built pretty much, is that you can have these large outpaced events that are hard to account for. So I'm going to be interested, because one of these days we're going to have it. We haven't had it yet in it yet, because I don't think we've hit the user base to get it, but we're on our way. So it'll be interesting to see, because usually a bunch of people deciding to do something irrational at any, whether it's exuberance or fear based. So great answers. Well, gentlemen, thank you. This is a lot of fun. I guess maybe just as a side question, because we're always interested in one of the things that we find most exciting about this space is kind of the venture capital sector, the asymmetric potential that's in this space. With all these growths to the company and the changes into the sector, where'd you guys start with funding? Where you, if that's disclosable information, I'm not sure. If not, we could just skip that question.
No, we can talk about that. Yep.
Yeah. It's fun for us. We're all learning. I think it's a good, and it's always a good educational process for entrepreneurs as well, to understand, how the growth, the process, how long it takes, the products that people are building. So I think it'd be fun.
Sure. So I can talk about this. So we actually, Scott also, like I said before, so 2020 we start building this, and then I think that so we actually went out and want to raise. I think the environment is totally different from 2020, beginning of 2020. To now. But at that time, so we still trying to go to VCs. Trying to raise funds. Now lots of projects. There is a ICO booming time, but now it's also project. Launch token and then raise. At the beginning of 2020. So we go to VCs. Actually, when we start. The COVID-19 actually break out, and then we end up cannot meet anyone. So we actually have a long time that we cannot raise anything, cannot meet people. But
that's a frequent story. Yeah, that's often how it happens. Trying to raise. So much is about timing too, identifiably a big part of the process is the resilience to wait for those moments when the timing is right, to follow along the wave is one of the big things for me where I learned about the pandemic was, I'm sure everyone's heard this quote, and everyone in the Bear family knows that idea of buy when there's blood in the streets. And you hear this idea, it's over 130 years old. And it sounds like a metaphor, but it's a very literal moment of human fear, of unknown conditions. Often, apparently, this time in 2020, when people were apparently or at least appeared to be dying in the street at one point. I'm not sure, but that was kind of really hit home for me, at least for measuring the sentiment. And a lot of times, companies' growth is like that too. You just get these. Sometimes they're more institutionally based as well. The whole globe might not notice an institutional lull, and I don't know, if you happen to work in balsamic vinegar and there's a drought that year, it'd be a specific isolated event within an industry or something, right? It's not always global. Sometimes it's global, but not always. Sometimes it's industry specific, that fear, and usually right after that fear is a great time to start trying to raise capital.
So personally, I think the VC or the investor who invests at that time is a really great investor. So that's kind of the time they show their, their color or how good they are. But
they move everything too. Usually, the exuberance outwards moves everything, because everything's on sale then at that point, and you can tell. You don't even have to be good at that point to know that if you're buying a collector's items or assets in these heightened moments of fear, you're going to get a good deal if someone's actually selling it. It's such an interesting part. We do a lot of charting and technical analysis, and what we're always trying to get the point across is that you're actually looking for physiological sensations of fear or greed in the ecosystem, whether it's institutional, isolated, silo, or it's a global event. You have the same effect on the industry itself, which is a fascinating about price and value. So, I had a great time chatting with you both. If everyone wants to find you as Perp.Fi, the links will be down in the description below. I'll be interested to see how version 2 launches. So we'll keep in contact with you guys, and we'll stay in touch just to see how what you're building evolves. I think it looks like a lot of fun. I like using leverage, especially at the right time in small doses, because it can be. We already have asymmetric upside in this ecosystem. You don't need to be too highly leveraged in anything, and be able to enjoy the ride pretty much even with the volatility, as long as you can cover your position. So it's I think it's a very useful tool. So it's nice to see coming out in the decentralized world. Good work on that. Is there any last thoughts you would like to leave with the Bear family before we end tonight's episode?
Yeah. So happy to be here, and I think that I guess like from our point of view, I think derivative is kind of like the next battleground for like crypto. So for DeFi. So not only us, a lot of our competitors, a lot of our other like derivative like options, like interest rate swap, like lots of people building it. I personally believe that there will be another like crypto summer happening.
Yes, soon. And winter and summer again, hopefully again.
Yeah.
Beautiful.
Cool.
I love it. And Nick, you got you want to leave us out with some parting thoughts as well?
I think actually Yenwen covered it really well. The only other thing I'd say is anyone who wants to kind of get involved, like we've got our Discord. People normally kind of hop in and join the community and kind of chat and learn more there. Otherwise, as you said, Perp.Fi is the website. It's got all the information.
Yeah, awesome. Yenwen, Nick, great to chat with you. And just to touch on that base too, one of the thoughts around leverage is not necessarily just leverage itself. It's how it can equate to other parts of the way the ecosystem works. I think that's going to be one of those like laser moments where we're like, oh yeah, there we go. Like now we can edit eyeballs with this type of stuff. So super fascinating. Keep up the good work. And we'll see you guys again on the next episode. Bear family, give us a thumbs up if you like this content. Comments, all those fun things. You know the drill down below. Check out Perp.Fi. Nick, Yenwen, thank you for chatting this evening, and we'll see. Bear family, thank you guys.
Yeah, thanks for having us.